Hello, my name is Kayla Weaver, and I'm a CPA at Arndt & Company CPAs. If you're self-employed and are wondering how you might be able to save on self-employment taxes, then this video might be a great resource for you, as we'll compare Schedule C payroll taxes versus S corporation payroll taxes and how to get set up as an S corporation when it makes sense. Now you notice that I said payroll taxes. This is because income taxes are going to be the same under either scenario. So the savings come across when we look at each type of payroll taxes. So let's start with Schedule C. The Schedule C payroll taxes are reported on Form 1040. That is your individual income tax return. They're referred to as self-employment taxes, and they equate to 15.3% of your Schedule C net income. This 15.3% comes from Social Security and Medicare. Essentially, even though you're self-employed, you still have to pay into the Social Security and Medicare systems, just as if you would if you were a W-2 employee. Now, I do want to note that Social Security is maxed out at $137,700 for 2020. That changes each year, and that's 12.4% of that 15.3% total. So here's a quick example of the self-employment taxes you might see as a Schedule C. So if you have $150,000 in revenue and $50,000 in expenses, then your net income is $100,000. At the 15.3% self-employment tax rate, that equates to $15,300 of self-employment taxes. Now let's look at the S corporation payroll taxes. As an S corporation, you're an employee of your business because the IRS requires that you pay yourself a reasonable compensation. Now, there's no one-size-fits-all calculation to compute the reasonable compensation, but instead the IRS gives some guidelines on how to compute your reasonable compensation amount. So they say you can look at where your gross receipts are coming from. There's three main sources. You can see, are you mostly earning your money from services you're providing as a shareholder? Are you mostly getting your revenue from services of non-shareholder employees? Or are you mostly getting your revenue from capital and equipment in your business? Or is it a mix of the above? So depending on what you determine here, you might determine your reasonable compensation needs to be a little higher, or maybe it needs to be a little lower, depending on these factors here. Now they also give some other factors that you can look at to help determine your reasonable compensation, and I'll just pick out a few here. So when you're determining that amount, you might look at your training and experience. So do you have a lot of years in this field? Do you have maybe a degree in this field or a specific license? You can look at payments to non-shareholder employees. So do you have a lot of employees that you've been paying out as well, and do you need to make more or less than them? What would it make sense there? As well as you could look at what a comparable business would pay for similar services. So you could say, if I was to go work for a competitor and do exactly what I'm doing now, what do I think they would pay me? So you can use a mixture of these factors to kind of help you determine what you believe is a reasonable compensation. Whatever amount you do come up with, we encourage you to keep documentation of that methodology. In the case of an IRS audit, you could support your reasonable wage amount by showing this documentation that shows how you came up with that dollar amount. This is important because anything that's not paid out as a wage can be a shareholder distribution. As shareholder distributions are payroll tax free. So you're only paying payroll taxes on your reasonable compensation. Anything else can just be taken out of the business as a distribution, and you're not paying payroll taxes on that. So that's why people might lean towards paying themselves a lower reasonable wage and sometimes really pushing the envelope because they're trying to minimize those payroll taxes. And again, that's why we encourage you to keep documentation of how you came up with that reasonable wage amount. So let's look at an example here for an S corporation. So just as before, we'll still have the $150K in revenue and $50K in expenses, and that's before looking at your shareholder wage amount, which gives us the same $100,000 of net income, again before the shareholder wage amount. So we're going to say in this instance, we feel like $35,000 is a reasonable wage for us as a shareholder of our company. So we take that $35,000, we multiply it times the 15.3% FICA tax rate. This is the equivalent of the self-employment taxes under Schedule C. It's just referred to as FICA taxes here since it's on a W-2. And then I also added in $200 just estimating unemployment taxes that you would pay as an employer to the state and federal governments for the unemployment system. So in total, on your $35,000 reasonable wage, you're paying $5,555 about in payroll taxes. You can see here with a side-by-side comparison that as a Schedule C, you are paying $15,300 of self-employment taxes on your 100K of net income, whereas an S corporation, you're only paying $5,555 in payroll taxes on your $100,000 of net income, because you're not getting taxed or payroll taxed on the full $100,000 of net income. You're only getting those taxes on your reasonable wage of $35,000. So the remaining $65,000 is what you can withdraw payroll tax free. So with these two figures compared here, we can see that as an S corporation, you would save $9,745 in payroll tax savings. So there are some other considerations I want to mention to deciding whether or not to become an S corporation. So we've talked about the payroll tax savings. There are also some additional costs when you're an S corporation as compared to a Schedule C. So an S corporation is going to have an additional annual tax return, a Form 1120S, whereas with your Schedule C, that just went directly on your Form 1040. You also have payroll processing fees. Now that you have to pay yourself a reasonable wage, that means that you're going to have to be filing potentially monthly, quarterly, and annual payroll tax returns, as well as remitting those taxes to the government. So you'll want to get it set up on a payroll processor, and that will have some extra fees incurred there. You'll also have accounting fees, so likely as a Schedule C, you might have just been keeping track in Excel or just handwriting down your revenues and expenses for the year. But as an S corporation, that tax return is more robust than a Schedule C. It has not only a profit and loss section, but it also has a balance sheet. So you'll need to have tied out financial statements in order to be able to prepare that tax return. That's why we actually require here at Arndt & Company that you're set up on accounting, whether it be monthly, quarterly, or maybe just an annual review. We require that you have a professional such as us look at your financials or do the monthly or quarterly accounting. That way you have those tied out financials ready for the tax return. Now, just one item I wanted to briefly mention is that some states have S corporation fees, whereas the federal government treats an S corporation as a pass-through entity, so you're not actually paying income taxes on the S corporation tax return. You're actually reporting and paying those on potentially the Form 1040, your individual income tax return. Some states say, nope, you're not a pass-through entity for us. You've still got to pay the corporation taxes. It's not going to flow through only to your individual income tax return. So one that I know off the top of my head is California. So you either have to pay a minimum of $800 for the year as an S corporation, or 1.5% of your net profits from the S corporation, whatever is greater. But then a lot of states still follow the federal taxation of it being a pass-through entity. So like here in Missouri, you're not paying an S corporation tax on that return. It's just flowing through to your individual income tax. So you'll want to look at your specific state and see the rules and guidelines it has to know if you'll have some type of state fee or not. So let's go ahead and look what our net savings would be using these extra costs. So we know that we were saving $9,745 when we elected to become an S corporation, as opposed to when we are putting everything on Schedule C. But we do have an extra tax return, so we're going to estimate $750 for that. We do have the payroll processing fees throughout the year, so we'll estimate $500 for that. And then we have monthly accounting for the year, and we'll estimate that at $3,000. So you're still going to be having net savings of just under $5,500, but you do want to take into account these extra fees that you have as an S corporation compared to not having those potentially as a Schedule C. Now, one other benefit I wanted to mention, as an S corporation, your S corporation tax return is actually 5 times less likely to be audited as compared to a Schedule C. Now, why is this? Well, it really goes back to the more robust tax return. So they know that that Form 1120-S is more difficult, and you're more likely to hire an accounting professional to help you keep track of your books and thus put those numbers, those tied out financials, on your tax return. A Schedule C, as I mentioned, you might just be writing down, here's my revenues for the year, here are my expenses, done. You might not have very good records and bookkeeping for that. So they keep that into consideration when they're looking at who to audit, and that's one reason why they are actually more likely to audit the Schedule C and 5 times less likely to audit an S corporation tax return. So if you've decided that becoming an S corporation sounds like a good idea, a good benefit for your company, how do you do that? Well, you can either form an LLC or you can form a corporation. If you form an LLC, that's a limited liability company, the default tax status with just one owner, one member, is going to be a disregarded entity, which means you're reported on Schedule C. When you form a corporation, that default tax status is a C corporation. So either way, to elect to become an S corporation, you'll need to file Form 2553. That tells the IRS, hey, I don't want to take that default tax status, I want to be an S corporation. Most often, we recommend and see clients choosing to become an LLC as opposed to just a true blue corporation, because the LLC is usually a little easier to set up, not as many annual requirements, etc. So that's usually what we're seeing here. Now, one important note I wanted to mention is that the earliest date you can start benefiting from S corporation taxation is either the date your LLC is formed, or if you've had an LLC formed for several years maybe and you just have always been Schedule C, but now you're thinking I want to be an S corporation, then you can use the first date of that tax year that you want to become an S corporation. So if you've just been working under your own name, maybe you've set up a DBA but you haven't set up an LLC, let's say you've done that from January 1 to March 31st, then all of those profits from January 1 to March 31st cannot go on the S corporation. They'll have to be a Schedule C. But then let's say April 1st you set up that LLC, start doing business there instead. Now you can use that LLC to elect the S corporation tax savings. So from April 1st and beyond, you can have the S corporation return and have those payroll tax savings that we talked about. That's all I have for you here. Thank you for watching. If you have any questions on self-employment taxes or how to become an S corporation, or you want to get set up on accounting and QuickBooks, just feel free to reach out to us. Thanks.